What is going on YouTube? My name is RJ and this is the Gen Z Investor channel where my goal is to change the way investors invest. Now, in this video, I'm going to describe options portfolio management. I'm going to first begin by breaking down kind of the goal of portfolio management from a kind of a stock perspective, and then I'm going to kind of incorporate some options strategies and kind of describe why options are slightly different than stocks in terms of portfolio management. And hopefully through this video you can kind of get a better understanding on how to optimize your portfolio. So just to begin, my mission statement is basically just to understand how to use uncorrelated assets to reduce the volatility of your own portfolio. Now, the whole point of finance, or more specifically your own individual portfolio, your goal should be to maximize your Sharpe ratio. So what this formula does is it measures your rate of return of your portfolio per standard deviation of the portfolio. So standard deviation is another word for volatility, which means risk of your portfolio. So the higher the Sharpe ratio, essentially that means you're being rewarded for taking on more risk that is adjusted. So a lot of people will claim that they either beat kind of the S&P 500 and then that means that they achieved alpha on the stock market. However, that is not necessarily the case. Really what you want to be looking at is the Sharpe ratio of a given person's portfolio, and that really gives a very good indication of basically how well their portfolio has performed. And just to explain this a little bit more, the RP is the return of your portfolio, the RF is the risk-free rate, which right now is pretty much at 0, and this is the standard deviation of the portfolio. So the problem is that when we sell naked options, there's a substantial reduction in your buying power, which basically means that you're going to have large positions. Therefore, ideally, we need to have positions on assets that are uncorrelated, which is a fancy word for they move in different directions. Again, when we sell naked options, we're going to have very large positions compared to a passive investor who just invests in the S&P 500. So it is very important to have uncorrelated assets, which I'm going to describe. This graph basically shows that as you increase the number of stocks in your portfolio, you are going to lower the annual standard deviation of your portfolio, which again is just a measurement of risk. Now, if we take a look at this graph, as you add more stocks in your portfolio, the annual standard deviation will decrease, but it will decrease at a decreasing rate. What this kind of tells us is that the more uncorrelated the assets, the steeper this graph is going to be. So as long as you have assets in your portfolio that do not have a perfect positive one correlation, adding a position will reduce your portfolio's volatility, all else equal. So if you were trading two assets that do have a perfect correlation, this graph would almost just make a straight line. And the more uncorrelated assets that you have in your portfolio, the steeper this graph is going to look, and you'll be able to basically take advantage of decreasing the standard deviation of your portfolio. So the solution to having this concentration risk is to trade underlyings that historically have been uncorrelated with one another. How do I go about doing this? So using an online website, type in the tickers you're going to trade and see how correlated they are with one another. So in my case, I used a website called Portfolio Visualizer. All I did was type in stock correlations onto Google. So you can use any number of different sites. So you can identify how correlated the underlyings are that you are trading. Additionally, you can go onto Yahoo Finance and download historical data. And if you know how to use Excel or Python, you can make a correlation matrix. So first I want to give an example of two underlyings that are in the same industry and try to describe why you should never trade two naked positions that are in the same industry. So In this case, we have JP Morgan and we've got Bank of America. As you'll notice, the correlation is rather high, 0.71, which is closer to that 1, which would be a perfect correlation. So in this situation, it would not be ideal because these underlyings are kind of going to move in the same direction. And again, you won't have that benefit of decreasing your portfolio's volatility. Now, here is a more ideal portfolio structure for trading naked options. Here is 5 underlyings in different industries plus gold. So we've got United Health Group, Facebook, Boeing, McDonald's, Electronic Arts. So United Health Group is healthcare, Facebook is social media, Boeing is commercial airplanes, McDonald's is food, obviously, and Electronic Arts is gaming. So we've got multiple different industries along with gold. Now, what I want to point out is when you make this correlation matrix of the underlyings you want to trade, make sure that you do not have anything that's above a 0.5 correlation as a general rule of thumb. All these positions have somewhat of a correlation, which you're not going to be able to avoid in the stock market because there's going to be systematic risk in every single stock that you invest in. But from this kind of portfolio, the highest correlated underlying is Boeing and United Health, which would be a 0.33 correlation. Additionally, gold is very uncorrelated with the stock market, so it provides very good diversification benefits when you are trying to optimize your portfolio. So it can be used to reduce your portfolio's volatility and increase the Sharpe ratio of your portfolio. So what I want to say is that when you trade naked options, you really don't want to have more than 5 positions on at a time, just because there's not that many opportunities for a given time frame. Additionally, what I mentioned earlier is the reduction of the buying power in your account. So most likely you won't be able to trade a lot of underlyings anyways. So going back to this graph, you will get more diversification benefits or lower your portfolio volatility if you trade more uncorrelated assets. Additionally, I want to break down an example for you so that you understand the difference between selling options and just outright owning stock. So let's assume right now Facebook is trading at $180 and you sell a $160 naked put option. For doing so, you collect $1 per contract in premium, which would make your break-even point $159. So when selling option premium, you have a lot more flexibility directionally to be wrong, because as long as Facebook trades above $159 before the expiration date of that option, you will essentially make a profit. This means that you have more room for error, and in the worst case scenario, you will end up owning stock in Facebook with a cost basis of $159. So when selling option premium, there are basically 3 ways that you're making money. First is direction. So just like stock, if the underlying moves up and you sold a put in that underlying, the price of the option will decrease, all else equal. But what I want to point out is that when you sell option premium, you do have a safety net. The stock can move against you directionally and you can still end up making money on that position. So this is a cool thing because not only do you have more control over your portfolio, you don't necessarily have to be able to predict future price movements in order to be profitable. Additionally, we make money by time. So when we sell option premium, we are essentially acting as insurance brokers. However, unlike insurance, which if you buy a 12-month policy or a 5-year policy, it will decay linearly. In the option market, the decay of the premium on the option is actually non-linear, and there's actually optimal times to sell option premium, which is about 45 days till expiration. However, as time passes, those option prices will decrease and you'll be able to close out those positions for profits before they actually expire. Additionally, we make money from implied volatility being overstated. So if volatility expands, then the likelihood of the option being in the money increases and the options will increase in price. If volatility contracts, then the likelihood of the option being in the money decreases and the options will decrease in price. The main point of these statements is that unlike stock, you do not have to be able to time the market and basically predict where a stock is going to go next. There's actually a better way of making money on the stock market that gives you a lot more freedom and a lot more flexibility to being profitable. So that is my options portfolio management video. Again, it is so important that you trade uncorrelated assets because this will reduce your portfolio's volatility and increase the Sharpe ratio of your portfolio. Hopefully you can take this information and make more money for yourself on the stock market. Please make sure to like this video if you enjoyed my content. Comment down below if you have any questions and subscribe to my channel for more content. Again, my name is RJ and this has been the Gen Z Investor channel, and I hope you have a wonderful rest of your day. Peace out.